Good afternoon, everybody. Thank you for joining us for our presentation today on current regulatory and compliance hot topics. My name is Angela Turiano, and I'm a principal at Bressler, Amery & Ross in its New York offices. With me today is Sean Coughlin, also a principal in the New York office. We were also with us today is Joe Calabrese, who we thankfully was willing to serve as a replacement on our panel today. We were supposed to get some representation from Alabama, but unfortunately, Josh Jones is a little bit under the weather today. So Joe graciously agreed to take his spot. Joe, Sean, and I are all part of the Financial Institutions Practice Group here at Bressler in the New York office. And in that capacity, we represent investment advisors and broker-dealers in various areas, including sales practice, complaints and arbitrations and litigation, employment arbitration and litigation, as well as enforcement defense. We also serve in an advisory capacity in these areas, as well as in the senior space. We are all actually members of the Senior and Vulnerable Investor Group at Bressler. So that's who we are.
We were all ex-assistant DAs in Brooklyn, New York.
That's true also. We all served at the Brooklyn DA's office. That's correct. So we go way back. So that's who we are. And what are we going to talk about today? Well, that's who we are. There we go. Today's topics, which were carefully selected, we were trying to focus on the topics that were at the forefront of SEC and FINRA concern in 2023. And the topics today will be unapproved communications, an SEC favorite of late, the use of social media, the SEC new marketing rule, an oldie but a goodie, Reg BI. We're going to talk about overview and best practices, as well as recent enforcement actions, cybersecurity risks, and finally, cryptocurrency, what happened and what's next. So those are our topics. And as I said, we carefully picked them to focus on what we thought was most important to the regulators in 2023. And to that end, they're in line with FINRA's recent 2023 exam priorities that was just released. A lot of these topics, in fact, all these topics are referenced in the exam priorities. And just on a related note, it's definitely a good idea to look at these exam priorities, but there's actually a related podcast, which I happen to look at, and I recommend it because there's three top regulators in various areas at FINRA, and they go over what FINRA intends to focus on in 2023, and it's a really good summary, and they highlight what they really are looking at firms to comply with in 2023, so I recommend that. And with that, I'm going to turn things over to Sean to talk about unapproved communications. And before he begins, I just want to mention two things. Number one, about halfway through, I'm going to be giving you a code. And then at the end, I'll give you another code for CLE. That's the first thing. And the second thing is, if anyone has any questions, I encourage you to use the Q&A link and not the comments, because it's the chat function, excuse me. It's much easier for us to keep track of the questions and save the questions in case we're unable to get them during the presentation today. If you put them in the Q&A function, we'll be able to go back and answer your questions. So with that, Sean, I turn it over to your capable hands.
Oh, thank you very much, Angela. So let's talk about unapproved communications. As I'm sure most of our viewers know, over the past couple of years, and specifically last year, the SEC and FINRA all began to really investigate and take a look at how people in the financial services industry were communicating with their clients. And if you think about it, I think those of us who are experienced in representing broker-dealers and being involved in that space, we probably would have at the time thought about those communications as texts that were exchanged between a financial advisor and their client, or perhaps between a financial advisor and their partner about a client, or between a financial advisor and their assistant about a client. And I think all of us over the past decade or two have had to deal with those types of communications, especially since the advent of the iPhone. But what's gone on now really is the SEC, and the focus has gone beyond just communications with retail customers, but really a focus now on the communications that engage at the firm. So between two traders, between people who are putting together banking deals, the SEC is looking at unapproved devices essentially any type of device that allows for allows for communications that are outside of the broker-dealer bank's ability to monitor those communications. And what we've seen is a huge explosion, especially once COVID happened and so many people started working off-site and not in the office. You know, instead of going next door and talking to your colleague, people started texting each other. They didn't get online. They didn't jump through the hoops necessary to do that. And so we're talking about Skype communications. We're talking about WhatsApp communications. We're talking about, you know, DMs, the ability to go on to Twitter and start direct messaging with other people. All of those communications, if it's about a client, if it's about a product, if it's about your business, these are all communications that, you know, there is an obligation under sections 203 and 204 of the Advisors Act to hold on to and to review. And so everybody's got to be mindful about this. And I think that we have to take steps in 2023 to really go in and make sure we're capturing the information of employees so that we can show compliance, because right now, you know, we saw billions of dollars in fines last year, but right now, I think the regulators are going to go beyond just the major firms they fine, but also looking at smaller firms and say, hey, are they in compliance too? So you're advised to make sure that you understand what's on your financial advisors or your employees' devices. How are they communicating with each other? I think one thing that most of us who have been representing advisors in this space over the past few years, I think many of us have come across situations where there are off-channel communications. And the only way to really effectively get that is to get the device that is used, whether it's a computer or whether it's a phone, and really scan the phone, use a vendor to scan that device, obtain the information off of that device. And then you get into a tricky area that Joe, Angela, and I have been dealing with for many of our clients, where it becomes important to turn around and figure out, well, what is firm communication versus what type of personal information does that financial advisor, broker, sales assistant, banker, trader have on their device, and what's pertinent and responsive that the firm should be holding on to, and what can you turn around and give the employee back their device. It's a very tricky area. It's going to be a difficult area for all of us to manage, but the regulators are mindful of those difficulties, but are absolutely requiring that we do that. I think I've covered that area pretty well there.
Yeah, and just to add to that, I remember a couple of years ago, I know a fixed income trader that called me up and said, you know, my firm is asking me to turn over my phone to a lawyer so they can look at my text. And I said, really? That's what they're doing? This was before this became a whole, you know, the SEC, this was before 2022. And I was surprised to hear they were going to do that. And he was concerned not because he had been communicating using his personal device to communicate business messages, but just because he didn't want some lawyer looking at his phone. So it's definitely a very sensitive area. And then, as Sean said, one that we've been dealing with. And something else I wanted to point out is that I mentioned the exam priorities. One thing that FINRA did say they were going to focus on is policies and procedures at firms and distinguishing between, not distinguishing, but making sure that texts are processed in the same and monitored in the same way emails are. And they're going to be looking at firms' policies and procedures, looking at firms' annual compliance questionnaire, which generally asks about communication such as this, and making sure that the financial advisors understand their obligation to comply, and that there's consequences for those financial advisors that don't comply. So obviously, it's definitely on the forefront of both the SEC and FINRA's ledger this year.
This area goes beyond, you know, people who think about just, you know, servicing clients or servicing products, because I'll tell you a little war story. You know, I recently had a settlement demand on New Year's Day, actually, and I reached out to the in-house counsel to let him know that I had received the settlement demand, and I actually texted it to him And I, of course, got the reply saying, please, all communication should be via, the firm methodologies. And I realized then, wow, because I just wanted to make sure that this particular person, was going to see something on New Year's Eve so I could relay it to them. So it's very, very important that firms develop policies and procedures to either distribute devices that they have control over or distribute an app that communications with clients have that they have a control over. This often comes up with clients from Central and South America who tend to turn around and communicate via WhatsApp instead of paying for texting or email usage. And it's something all of us need to be mindful of. And I think going forward, it's something that when you're defending a case, you need to really ask those questions and find out if there's other forms of communications between the advisors, brokers / and the clients, and also how the advisor communicated with their staff or colleagues.
And on that note, I know we have to move on, but a colleague was telling me about an arbitration, because this will sneak its ugly head into arbitration. The broker had 35,000 text messages to the client, and there was not a regulatory referral in this arbitration, but there certainly could have been, and it certainly didn't bode well for the financial advisor that I'm sure the other side was pointing out that they violated FINRA rules by texting offline. So it definitely comes up.
And somebody just asked in the chat if we've seen FINRA asking for non-business related communications, and that is just really one of the real concerns there. How do you distinguish what is a business communication versus what's a non-business communication? And that's why the best practice is really either using an app for all communications between employees and or customers or about products, or having the firm provide those devices in both cases, so there is an ability to review the communications and stay in compliance. And just like we got traditional texting type or email communications go out, there's also the concern that FINRA now has regarding the use of social media. And when we're talking about that, the SEC defines advertising as all forms of communication used to acquire or retain clients or investors. And I think this really comes to light when you start looking at, some of the communications, some of the blog posting that was occurring over the past couple of years regarding various, high-flying stocks that were traded, on people's phones, and what was going on there. And it's something first off, the best practice in terms of dealing with these types of communications is retention of all social media activity. And you've got to really understand what your employees are doing on social media. And you almost have to advise your employees just to, stay away from, in chats with their friends, posting comments about the market. Because of the way technology has gotten and how we are regulated, those are considered communications. So if a financial advisor, is turning around and touting certain stocks on the internet, via chat rooms, via Facebook, via Twitter, or via Reddit, or any of that, it's something the employers really need to be very mindful of, and keep it from happening, because the SEC and FINRA will look at that as advertising, and that's advertising that firms have a responsibility and obligation to monitor and be a part of. And I think with that, I've wasted almost 10 minutes of everybody's time. So we're going to go on to the next section about the SEC's new marketing rule.
Which is related, and they were 10 good minutes, Sean, so I wouldn't worry about it. Hold on, let me just click to the next page. There it goes. Okay, the SEC new marketing rule. This was approved back in December of 2020, and it came into effect in May of 2021. And then firms were given an 18-month reprieve to sort of get up to speed on the new regulation. And essentially, and it applies across the board to all investment advisors, including those to hedge funds and private funds and separately managed accounts. Basically what it is, it's a single rule, as our PowerPoint says, to replace the former advertising and cash solicitation rules. And it was designed to address evolving changes in advertising and cash solicitation related to technology, such as just as Sean was just talking about, the increased use of the internet and mobile applications and social media, et cetera. And what they say is it's intended to provide an adaptable framework for the protection of investors. And what that essentially means, and we're going to go over that in a second, is they give you a much more, instead of broadly drawn limitations, they actually sort of give you specific prohibitions of what you can and cannot do when you're advertising. It also, just a note, this rule was developed over many, many years. It was unchanged for a really long time, and there was no action letters and other guidance, but the rule was not changed for decades. And essentially what's happened now is those no action letters and that various guidance has sort of been encapsulated in this one new rule. So with that, I want to talk about the particular performance prohibitions when you are advertising. So for example, there are certain prohibitions that you can and can't do when you're advertising, unless. So if you're going to talk about performance results, you can do that, but only if you provide specified time periods. If you're going to talk about gross performance, or I should say you're prohibited from talking about gross performance unless you also talk about net performance. You're prohibited from talking about results of subsets of investments, unless of course you also talk about the performance results of the total portfolio. You're prohibited from talking about hypothetical performance unless you can show that you've taken reasonable steps to make sure that that you have reasonably designed to ensure that performance is relevant to your audience and their financial situation and investment objectives. And then you're prohibited from using, for example, any statement that the SEC has approved or reviewed any calculations or presentation of performance results. Those are just examples of different prohibitions. So the rule is much more, it's instead of being broadly drawn, it gives you specific prohibitions and what you can and cannot do. It also does allow for third-party ratings, but you have to include specific disclosures. Such disclosures would include if there's, you talk about a third-party rating and there was a survey, the survey must have been set up so that you gave the person taking the survey the opportunity to really express what they thought. So it can't be one of those loaded questions like you thought your advisor was great or the best you ever had. You had to you have to make sure that the survey is a fair survey that gives the individual, the person taking the survey, the opportunity to really express what they believe. So it has to be full disclosure in that regard. The rule also prohibits lying, fraudulent omissions, causing misleading inferences, and failing to put forth a fair and balanced presentation. It does allow for the use of testimonial and endorsements, but again, with appropriate disclosures. It requires clear and prominent disclosure of relationships, compensation, and any conflicts of interest. And it also, you must show compliance with the marketing rule and enter into a written agreement with promoters. It also disqualifies certain bad actors from acting as promoters. So it's kind of codified a lot of what's been developed over the years and gives much more guidance about what you can and cannot do in this space. Takeaways that are important with regarding this rule is, and we're going to be talking about this a lot today, is policies and procedures. It's suggested, and suggested means you need to do it. It's suggested that for part of your policies and procedures that you have like pre-approved templates and disclosures regarding advertisements, editing guidelines, including with respect to social media activity, and internal pre-review and approval processes as part of the written policies and procedures to comply with the new rule. It also talks about spot checking. They have procedures in place that can spot check the advertising, as well as doing periodic reviews. So they really want firms to stay on top of this and make sure that everyone's complying and complying with all the new specific prohibitions. And something else, of course, is books and records. Advisors are told that they must comply with the new amended books and records rule, including the Form ADV. Firms are now required to disclose on the Form ADV their marketing practices, as well as keeping copies of advertisements and disclosures for the SEC's review. This is all very important to keep in mind. This is a new rule, as we know, just firms required to comply with it as of November 2022. So we'll see how this plays out in 2023. But I will say that there was a risk alert put out by the SEC in September of 2022 regarding the new marketing rule. And the SEC specifically said that they're going to focus on the following, that firms have appropriate policies and procedures with regard to the rule, that they have a reasonable basis for believing that they will be able to substantiate material statements of fact in advertising, that they complied with the rule's performance advertising prohibitions. And I just referenced some of them. That was certainly, that was not an all-encompassing list. And of course, maintaining the proper books and records, as I just mentioned. So it's something that firms should definitely keep in mind and make sure that they're complying with. So that is the new marketing rule. And with that, we're going to move on to another topic that is always a topic of great discussion, which is Reg BI. And I'm going to turn that over to Joe to talk about that. Joe?
I've always said I'm not Josh, but I play him during webinars. I won't burden you with my Southern accent because it might be more insulting than anything else. But I appreciate you asking me to come along today and help you guys out. Our good friend and our distant cousin, Reg BI. What more can be said about a rule that is so broad and so wide in scope that it is almost impossible to understand and prepare for and enforce? So back in 2019, when we were all made aware of this rule coming down the pike, so to speak, we all started to worry about what we were all going to do in June of 2020 when the compliance date actually came. That day kind of came and went. The pandemic, like everything else, got in the way of that. And since then, we've all been really waiting for the other shoe to drop as to how the regulators were going to test all of us in the industry on how we applied this very well-intentioned, but sometimes very vague and hard to understand rule. And for some time, a lot of that didn't happen. The other shoe has dropped. So actually on the 30th, only a couple of days ago, the SEC put out from the exams group, an SEC risk alert. And it talked about exactly what Angela just referred to a couple of minutes ago, about how the SEC is now going to be really looking very closely at policies and procedures. Firms have now had practically 3 years to start putting policies and procedures in place. And it won't surprise you that the SEC has found a tremendous amount of deficiencies in the areas of policies and procedures and compliance, excuse me, in particular, in member firms. We could probably do a separate webinar on that alert and what the SEC is looking for and talking about. But in the context of today's conversation, where we had planned to talk about Reg BI anyway, it makes it all the more important that the industry understand what is now being expected of us, because the SEC is now, in people's files and looking at what they're doing and is coming out with findings that you all have to be aware of. So before we dig deep into that, we should step back for a second and let's talk about Reg BI, right? So we know, if you've listened to any of our podcasts or seminars before on Reg BI, and we talk about it once a year just to try to keep up with it, the beginning and the ending is that firms are going to be held to a higher standard of recommending investments to their clients, where they have to put their clients first. Now, every firm says it does that, but Reg BI now really codifies that it's the interests of the investor that must be put first at all times, and it goes beyond just the suitability of the investment. So let's dig in a little bit to what that means. As you know, Reg BI has a much broader definition. The Reg BI requires or applies to retail clients. And I think we all have our ideas of what retail clients are. But the rule itself expands that definition of retail client to really be any natural person or any legal entity working on that person's behalf. That is as broad as it possibly can be. I was reading an article about it the other day, and somebody referred to it as, jokingly, but really true, the two-leg test. If it has 2 legs, it's a client, right? Or if it represents somebody with 2 legs, it has a client. It is a client under Reg BI. So you have to, this is not, well, this was a suitable transaction because it was a sophisticated client, or it was an unsuitable transaction because of the level of sophistication. In the world of Reg BI, none of that matters. If you have a retail client, sophistication doesn't make any difference whatsoever. You're already covered by the rules. To make things even more difficult, it applies to potential clients. It applies to people because many times recommendations are made to people who aren't clients yet.
Yep.
Now, the question, it begs the question, well, if they don't become clients and there's no harm, there's no foul, what's the difference? Well, the difference is firms are going to be reviewed on all the policies and procedures that they have in approaching potential clients, number one. And if you fail in that respect, whether you bring the client in doesn't make any difference whatsoever. And number two, it ties right into all the rules about advertising. Are you disclosing enough to your potential clients about whatever interests you have in the product that you're talking about, sufficient to comply with Reg BI? So the old adage that we say is, well, listen, the recommendation might not have been what we wanted. The client didn't buy it. The client went with someone else or did something else that we didn't recommend. Doesn't necessarily make a difference. These are potential clients as well. So it's incredibly broad. The standard of care, is much, much higher than suitability. It's a fiduciary standard of care where our clients have to make sure that what they're doing is in the best interests of their own clients. There are disclosure requirements. There's the Form CRS record keeping and the disclosures as well. I want to talk to you actually on those points, what the new alert actually spoke about. And we're going to do this very broadly because it is very new and it's not exactly the topic of today, but we should talk about it. So let's go back when we're talking to Reg BI is how Reg BI is actually defined. So Reg BI generally provides that when making a recommendation of any securities transaction, again, as broad as we can get, or investment strategy involving securities to a retail customer, broker-dealer and their professionals must act in the best interests of the retail customer at the time that the recommendation is made, without placing their own financial interests ahead of the customer's interests. That's what they were looking at. And what they found, and when they looked at the policies and procedures of the people that they looked through, they found deficiencies in policy procedures, and particularly in compliance policies and procedures that had to do with the disclosure obligation that we just spoke about, the duty of care obligation that we just spoke about. So it goes on and on and on, and I don't want to take more time than necessary. Our message today is, if you are responsible for the maintenance and the creation of policies and procedures, and you have not been up to date on Reg BI because you say, well, we generally put our clients first, that is not good enough. You are really going to have to drill down. And I recommend you reading this. It's obviously on the SEC website. If you need the link, we can send it to you. But this really shows you where they're going and what they found. And of course, obviously, you don't want to be on the wrong side of that.
And
So let's talk about who,
I'm sorry,
besides
Joe,
who.
if I could just jump in on that real
Yeah,
quick on the policies
sure.
and procedures piece. I agree that the risk alert is great. And one thing that everyone should take note of is that they're looking not in the policies and procedures, their findings were that a lot of firms were just repeating the Reg BI verbiage and not actually giving any specific guidance how to achieve compliance. And that was a big issue. So you can't just restate the language of Reg BI. You need to say, there's a duty of care. There's a duty to disclose conflicts, and then describe different ways to achieve that goal. And that was one of the things that they found lacking in a lot of the policies and procedure manuals that they reviewed. So sorry to interrupt you.
No, it's a good point. You can't just repeat the rule and hope people understand it. I wanted to give you a few minutes on what the standard of care is, and then also what type of accounts are targeted here. And it shouldn't be a surprise to you, specifically retirement accounts, rollovers, things of that nature. Reg BI covers everything, but the focus really here is retirement accounts, for obvious reasons, because that's where people have the most risk. The standard of care, which is in slide 8, if you could move that up for me, is the last thing we'll talk about today. And I think we've covered some of it and out of the language of the alert. The best interest of the client. So again, what do they tell us? The recommendations have to be in the best interest of the client. There is a similar duty of loyalty. All good laws are supposed to define their terms, all good regulations, all good laws. They don't define, the SEC doesn't define best interests, but I think, it's one of those things where you kind of know it where you see it. You have to disclose commissions that you can earn from doing this. You have to disclose whether or not this is a proprietary product. You have to disclose if there's going to be a trail. And when you hear some of these words, what do you think? You think annuities, right? So anything you're going to have a long-term relationship with the client and or the investment, alternative investments, long-term notes, all of these things, you've got to let the client know what you're in for. And whether or not that product with all of those other things that come with it, and it's not necessarily just the degree of cost, it's the fact that that cost exists, that you have to be much more transparent. It applies to individual securities, but it also applies to investment strategies, right? So if you're talking about the strategy of maybe balancing insurance products with long-term debt or short-term debt, or balancing equities with other types of products, it's not just the one thing. Well, this is why you should do this with this one product. It's the entire strategy. And again, and I want to keep us close to time, we look very closely, and the regulator is going to look very closely to rollovers. And the other three on the slide I find very interesting, besides IRAs, 529 accounts, right? Most 529 accounts are, as you know, are college savings accounts. They have mutual funds that build most of them. But now all of a sudden, because we're not just saving for someone's retirement, we're saving for someone's education. And those gains are obviously have tax treatment, which is preferred under the IRS code. You got to be very careful with those too.
And
So-
right there, Joe, there was, the regulators just a couple of years ago went in and looked at the 529 plans and did a determination as to whether or not investors should be an A share, B share, or C share, where they were offered. And it was really all about making sure that the right shares were sold based upon the length of the investment
Time left, right? No, very true. So that covers it in terms of Reg BI. I'll be back with you more in a little bit later, but I will leave it up to you, Angela, to move us on to the next topic.
Okay, great. Thanks, Joe. And a couple things before we move on. Another thing with just sticking with Reg BI for 1 second is the FINRA focus on, they've been focusing at least in the exam priorities on the financial advisor and with regard to recommendations, that they actually understand the product they're recommending. And that's a big focus this year. Do they understand, like a variable annuity, with variable annuities, for example, that's always a question, whether financial advisor that's recommending it understands it. And I'm going to talk about a case in just a second where there's a product involved where that's what they was finding, that the investment advisor didn't fully understand the product they were recommending.
Before we go on, let's talk about a code.
And that was my next topic. So the first code, much to the chagrin of all those Eagles fans out there, is Giants. We can't be in the Super Bowl, but we're going to use it as the code today. So it's Giants.
Sean came up with that, right?
Yeah.
It was actually so. I actually said we should say Eagles, Chiefs, but I got the kibosh.
I wasn't
Giants.
consulted. I only got in on this 25 minutes ago. So
And the other thing I wanted to say was that there are a number of questions that have been popping up in the Q&A. So we will try to get to them at the end, and if we don't have time, we will respond to each and every one of them offline if we can't get to them. So I see that they are popping up, and we haven't had an opportunity to respond to all of them.
I responded to a couple.
Yeah.
Yeah.
Okay, so I'm going to talk to you about a couple of actions under Reg BI. So first, the SEC, an action against Western International Securities, and this involved something called an L bond, which is essentially, it was L bond was a specialty high yield bond created by a company called GWG Holdings from 2012 through 2021. And the bond financed the purchase of life insurance policies from policyholders at a price higher than the surrender value, but less than the benefit value. And essentially, what the investment was that you'd hopefully, it was like a timing thing. Okay, so I'm going to bet that these individuals are going to pass away in a shorter amount of time, then I'm going to be able to earn a profit than I have to, because you take, as an investor, you take over the payments for the policy payments. So it's kind of like a timing thing. Am I going to spend more paying for the surrender value of the insurance policy and then paying the premiums? Is that going to end up paying more, or is the policyholder going to pass away? So it's a little bit of a morbid investment, but in any case, this firm was charged, and its 5 representatives were charged with violating the rule by, and the focus was that these investments were very speculative and illiquid. And for the most part, the individuals that these L bonds were recommended to were, just moderate to conservative investors that were all on a fixed income. So that was the focus. And so the SEC, the findings of the SEC was that the advisors did not understand the risks and costs of the investment. And the recommendation was not in the best interest of the client because, as I said, the clients were moderate risk investors on a fixed income. There was also an issue with the violation of duty of compliance because of the policies and procedures, and they were not reasonably designed to achieve compliance with Reg BI. So this, and again, as I mentioned before, they found that an issue with the policies and procedures that they weren't specific enough and not reasonably designed to achieve compliance with Reg BI, as I said. And here, reps provided unreasonable, vague, and generic rationales for why they sold L bonds to risk-averse investors. Mismatch between client situation and investment risks. So this was a recent enforcement action under Reg BI by the SEC. The next one I want to talk about involves a FINRA enforcement action. And this actually is a case that involves churning. This individual, Mr. Malico, was suspended for 6 months and received a $5,000 fine. And it was for, churning, I feel, was one of those things we used to see back in the early 2000s. But in this particular situation, the individual investor was 63 years old. He had, I think his net worth was $100,000, and he had an average balance in his account of less than $30,000. But still, in a 16-month period, this advisor recommended more than 350 trades and earned $54,000 in commissions. Also, there was some in and out trading in like a 6-month period. So in a shorter period of time, he was recommending purchasing in this one biotech stock. He purchased, purchase it one day, sell it the next day. And in this 6-month period, there was $6,000 in losses and $3,200 in commissions, as I said, in one biotech stock. The total losses over the 16-month period was $17,500. So we're not talking big, large amounts of losses, although for this individual, I'm sure it was a very large loss. But the issue obviously was the type of trading he was doing, the excessive trading in violation of Reg BI. And certainly I would say this type of trading would also be unsuitable, but this is actually one of the first actions, enforcement actions by FINRA as a violation of churning actions, a violation of Reg BI. And in that podcast I referenced, they actually talk about that. They talk about that. Mike Solomon, who runs FINRA examination, talks about that FINRA is going to be focusing going forward not just on the policies and procedures, but on more on the point of sale activities of financial advisors. And in doing so, and its compliance with Reg BI, and in doing so, he referenced this first case regarding Reg BI and churning. And so it's likely that we'll be seeing more of these types of cases in 2023. So just 2 examples of enforcement actions under Reg BI and how these regulators are going to, utilize Reg BI to, really try to prevent and protect investors from this type of activity. So with that, we are going to move on to still on a topic of Reg BI. We're going to talk about the importance of record keeping with regard to recommendations. And I believe, Sean, you're going to cover this.
Yes. So notes, something that we are always seeking, always wanting. Arbitrators want them. When we all started this, or at least when I started this, because I'm older than my colleagues on the panel, brokers used to tell you, well, it's okay, the confirmation, is the record. But everything has changed, and it's really changed dramatically in the last 10 years, and especially with Reg BI. And, number one, you should document your notes in the note-taking system. And those notes should be pertinent, and they should be about the recommendations that are being made. And it isn't just something that deals with the salesperson, because the standard now and the obligation now is that there is a duty to monitor these recommendations, these notes, what the brokers, advisors are recommending. And remember, you've got a fiduciary duty to record the implicit and explicit basis of the recommendation. Is it a recommendation to buy, sell, hold? Put down the reasons right there. And so often we see financial advisors not meeting those obligations. And the ones who meet the obligations tend to steer out of trouble. But the ones who forget to take those notes, don't believe they need to take those notes, the supervisors who aren't following up with those notes, those are the ones that are going to, have more scrutiny. And if you think about 2022, where we had, a real significant decline in the market, it's expected that as clients are doing their taxes this year, they're going to go back and take a look at what happened. And, were there recommendations made at the beginning of 2022 to continue to hold and ride out the market? And maybe there are, maybe there aren't, but we need to make sure that notes, proper notes, good notes are there in the system for people to see, and that there is the ability for a risk/compliance team to turn around and follow up on the suitability of the trade, the selection of the strategy. And remember, not just in litigation, but also in any type of regulatory examination, the SEC and FINRA, and for that matter, to the extent that states are involved in this, they're looking for this documentation too. Gone are the days when simple notes are out there that are describing, some of the broader issues that go on between clients and their advisors. You really need to turn around and document what you're recommending and why.
And just on that note, I found it odd that, the Reg BI, the care obligation under Reg BI does not obligate advisors to make records of their recommendations. It's recommended, especially with complex and risky products or expensive products, but it's not an obligation. So it's kind of funny to me because it's like, I think it's strongly recommended, but it's not an obligation, which I feel like it probably should be, because I think they clearly expect it, right?
Yeah, I think you're right. And it's really just best practice. Every single case that we've been involved in, it comes up, and it comes up from the individuals representing the claimants. Where are the notes? But oftentimes it will come up from arbitrators themselves, and an expectation that people involved in financial services have the same type of notes documenting what they're doing that we find in so many other different walks of life, because these individuals are providing professional services.
Right. And as you said, Sean, it's not just about the notes and simple notes. They have to be substantive notes that actually set forth what the advisor recommended. It. Did he advise for the risk? Did he or she say exactly what they're recommending? So it can't just be like spoke to client. They have to be like good substantive notes.
Right. So should we go back onto cybersecurity?
Cybersecurity. Yep. And that is Joe.
That's me. Yep.
Did you study up on it in the 5 minutes you had to prepare for today's presentation?
The reality is, this is the one thing you don't have to study because it's an everyday occurrence. The amount of emails that I get telling me I have won a prize, or I immediately need to click a link because my Apple account has been frozen. Those numbers just seem to get higher and higher and higher. And I guess we joke about it, right? But for those of you who have been on the wrong end of a cyber attack, have been the victims of identity fraud, have worked at firms where client information was either taken or used inappropriately, and all of the bad things that come from that, it's something it's never going to get better. It's only going to get worse. And really, the best, to use a football reference, the best offense really is a very good defense. Predominantly, the risk that we still see, and it hasn't really changed as to how they get in, is email compromise. Even in our own firms, I get emails now from members of my own firm telling me that they need me to help them with something. They need me to review something. They're going to be out next week. Can I cover something for them? And it's becoming fairly regular that none of those are legitimate. And so once an intruder has your email address, they now have a way not only to get you to click on links that you shouldn't, but to socially engineer you into believing things that are absolutely not the truth. We know that these criminals will always impersonate a trusted contact or other party. Like I just said, internal or external. It's almost like I read the deck before I started today. And things of that nature. And really the goal is, and I'm sure any of you who work in any large organizations or in law firms or in-house have taken these trainings, which go, I know, from like the sublime to the ridiculous. But there's always this call to action. There's always this, you have to convince someone that something has to be paid, or we have to move money, obviously, in our world, and it's got to be done yesterday. And so anything that raises that kind of specter, has to be scrutinized, because the minute that you click that link or you in good faith transfer that money, and when I used to do FA training at Morgan Stanley, we talked about this, and back then it was new, right? And now it's just life that if you're not aware of this, you're not paying attention. Certainly targets, besides we've got here obviously our executives and financial services professionals and legal, it's anybody who has an email in any of these firms. It could be anyone. A lot of times it's people that might be at a lower level who feel they have the need to reply to someone higher. An associate of mine sent me an email the other day that he got from me that said I needed something from him immediately and he needed to open a document. And he knew that wasn't the tone of voice that I approach people with. And he was smart enough to say, hey, is this you? Taking the risk that it might have been, of course. But there is now no one on the chain of command, so to speak, who is immune to this. I want to show you the example, the old wire transfer example. Angela, if you could move us up to 13, I'd appreciate it. So, request from the CEO, immediate, right? There's the first buzzword. Anybody that wants you to do anything yesterday is going to be the person you have to look out for, unless that is get your time in by the end of the month, and that you have to do yesterday, right? High importance, please process a wire transfer payment in the amount of $250,000 with these words and phrases. So the example we used to give was that, and now it's almost old school, right? We talk about Facebook and we talk about social media. It is not difficult for bad actors who know your clients to figure out where they are. And the example we used to give is people used to know when you got back from vacation. Now they know that you're going on vacation. They know where you're going. They know what you're going to see. And we have had instances where the bad actor emails the broker and says, hey, I'm in France. My wife has found this painting she's been looking for the rest of her entire life. I've got to pay it in cash. Here's our routing information to the bank in France. Please send us the $100,000. Broker knows the client's going to be in France. The broker knows they're in France right now. And of course, the cell phone never works because they're somewhere in the mountains and they can't be reached, but they need the money yesterday. All of that looks exactly like it's probably right, because some third party has been watching it. Now, all firms require, as you know, wires over a certain amount have to be a verbal. They have to talk to somebody. Well, but you've got it. If you've got a client with that much money and they're demanding, sorry,
that best practice is really to verify.
Yeah, it's just that.
Put through Zelle or something that the firm has control over. To verbally.
But we see that all the time. And what's even more infuriating is the client's not going to know about it until they get their statement at the end of the month, assuming they read their statements, and that's all the conversation, and say, where did that $100,000 go? There's no defense to this. There is absolutely no defense to this. Like, everyone's got a best practice. And we've all seen forums where there's been a checkbox that says FA or broker or a relationship manager spoke to the client. And maybe that's true and maybe it's not. But the fact of the matter is they are still getting in this way. And then finally, Angela, if you'd get us to 14, if you've watched any of our senior investor webinars that we do once or twice a year, we talk about who are the targets. So we've talked about people in the industry who are targets, right? Those of us who are responsible for servicing our clients' needs or for servicing the banks that take care of them. But who else are out there? And these are things that you already know. And we talk about these romance scams or any other type of scam where an isolated individual, particularly an elderly individual who lives on their own, who really believes that if they get an email or a text, it has to be important. We talk about this with the senior investors all the time. When I was a kid growing up in the 70s, we had one phone, and if it rang, everybody ran. Because if you made a phone call, it had to be important. Our elderly clients feel the same way. A text or an email has this. To the rest of it, it's a nuisance 9 times out of 10, right? But to them, it's important. So what you're going to find is people responding to things like this and then asking our clients, people in the field, I need to transfer money here. I need to do this. Look, you individually, as someone in the industry, can't stop that from happening, but you can be alert to it. If you start seeing that your senior investors or your vulnerable adults are asking you to do things that just might not make sense, 2 things. Don't be afraid to question it, either with them, and certainly don't be afraid to escalate it. It's not the point of the conversation today, but when it comes to the world of cybersecurity, remember, you're not only looking out for yourself, you're looking out for your clients. Sean's got a whole conversation about I'm sorry, Sean, go ahead.
If we can go back to those emails and those email instructions, just the best practices is to always turn around and take a look at exactly where the email address came from. Because it
Yep.
it might say Sean Coughlin on it. You
Yeah.
need to turn around and actually take a look. Does it say scoughlin@bressler.com or does it say something else?
Like-
Because
yeah.
that is the real tip off. And you know, does it have your client's real address on it? It's the number one protection thing that you can do to stay away from those types of scams.
Yeah,
Sorry.
you know, we all have to take those training,
Trainings.
the training classes, which seems silly, but sometimes, you know, if you're in a rush and you don't look carefully, you too could be the subject of a scam. So everybody should just be mindful of these types of things.
The worst part of it is you too could be the person who corrupts your entire firm's infrastructure because you clicked that link. That's
Right.
going to be a very uncomfortable conversation at the end of the day.
Very uncomfortable, yes.
And finally, Sean's got a whole section coming up on cryptocurrency, and I was happy they didn't ask me to talk about that because I'm still very, very unclear about what all of this fake money means. But scams related to crypto shouldn't surprise you, are on the rise, especially with the way that the market has changed. So I think that's more than obvious that anybody who wants to get you to invest in something that doesn't actually exist, you should be thinking about. But that word crypto now carries a lot of weight with it, not only with our regulators, but with our clients. And I think that's an excellent segue. So keep your eyes out for emails regarding that. And I'll turn you over to Sean for the rest.
Excellent
Sure.
segue to cryptocurrency.
Well, thank
How
you.
about you?
And if we just looked at that last graph, you know, you could see from the first quarter was half of the losses of the entire year, the year before. So clearly 2022, and we don't have the final number for it, but it was expected to, you know, have, you know, in excess of $1.3 billion in losses related to crypto scams. And all of that, and we can go to the next slide, all of that was actually while cryptocurrencies had a significant decline in value during the course of 2022. Crypto in November of 2022 was worth $16,000. It grew to almost $70,000. And for a Bitcoin, for one Bitcoin, which incidentally, my son purchased Bitcoin when he was going to college as a senior in high school. I think he purchased 3 Bitcoins for about $10 so he could purchase what I learned was his fake ID. All right. I think that he's probably kicking himself in the butt for selling or exchanging those 3 Bitcoins. Exchanging those 3 Bitcoins for that fake ID that was promptly grabbed by a bar someplace in Poughkeepsie, New York, because even if he held on to it, he'd be worth about $70,000. So you've had a significant rise and fall in crypto. You've seen a number of lenders go bankrupt during this past year. Crypto lenders, Genesis, BlockFi, Celsius, have all filed for bankruptcy. So let's go to the next slide. And I think everybody has been watching in some ways with bated breath what happened to Sam Bankman-Fried. In fact, you saw a couple years ago, I think during COVID, there was a whole thing about a young woman from Germany who pretended who pretended to be somebody she wasn't. I think that Netflix or Apple TV.
Inventing Anna.
Inventing Anna, correct. I think that we will soon see a very similar show come out regarding inventing Sam Bankman. It's probably to be expected. But you know, it's something that certainly caused people to take notice of the collapse and the fraudulent actions that have occurred there. And a lot of that is because crypto is still in a, let's go to the next slide. Next slide. Crypto is still in a bit of an unregulatory space. When what we saw over the last year was collapse of Terra USD dollar stablecoin. There are many who believe that that was very similar to a Ponzi scheme, and that helped bring down FTX. Other factors that have brought about this crackdown on crypto has been the Chinese government, and they're very mindful of the fact that crypto is used to try and get around their systems. And we've also had inflation and higher interest rates. So financing has been more difficult in the crypto space. These are all, important factors. Let's go to the next page, please. We have enough page. Okay, so what's next? Well, the current administration, said just last week that they are engaged in unveiling their priorities about crypto research and regulation in the very near future. Major financial institutions such as Morgan Stanley, Goldman Sachs, JP Morgan have been putting together trading desks. Fidelity recently opened up a crypto trading platform in November. So this is an area, despite the volatility and despite the lack of regulatory framework that has been out there, is evolving. There's an ongoing battle between the CFTC and the SEC over who is going to have jurisdiction over crypto. And hopefully our Congress will actually enact some legislation so that the regulators can get to work. However, in the meantime, you see New York State and other individual states stepping in and beginning to regulate things. New York State is actually considering a bill to allow agencies to accept crypto as a form of payment. And the New York City mayor is actually, when he first came into office, was accepting crypto as a salary. And with that, we have about 3 minutes for Angela to go through the new topics for the FINRA exam priorities.
And just a note about crypto. What I find amazing about it is that there are quite a number of vendors out there or stores out there, I should say, that actually accept crypto, which I just find the whole thing amazing. It's like sort of like you hold up a pen and say, I say this pen is worth this much money, and that's how much it's worth. So I find the whole thing fascinating. So I'll have to see how things turn out in 2023. And I know that crypto was referenced also in that the FINRA exam priorities that I keep referencing today. But as with regard to this, to priorities for 2023, there were some new topics that FINRA highlighted that they were going to be focusing on in 2023. There was a lot of repeat offenders on there, like Reg BI and communications with the public. But they mentioned 4 new topics, including an entirely new section called the financial crime section. But as for topics, one of the things that FINRA was going to say they're going to focus on is manipulative trading. And the report's findings included inadequate, here we are again with the policies and procedures, inadequate written supervisory procedures, non-specific surveillance thresholds, and surveillance deficiencies with regard to detection of manipulative trading. Another focus is on fixed income and fair pricing. Among the findings FINRA had was incorrect determination of prevailing market prices, outdated markdown grids, failure to consider the impact of failure to consider the impact of market price, of markup on yield to maturity, and unreasonable supervision. Fractional shares, there was reporting failures and inadequate supervisory systems and procedures among the different findings. And finally, there was Reg Show, which is essentially a regulation that was set out in 2005 to regulate short sales. And this section includes findings on non-bona fide market making and impermissible use of locates, again, involving like hard to borrow securities and threshold securities and short sales. There's a requirement that firms show a reasonable basis that they can locate the security and that can be delivered on time with respect to the short sale. And there was improper reuse of locates. Complicated regulation, but they actually, the way it's written out in the priorities, it's good. You should read it, and it makes a lot of sense. And these are the things that FINRA is going to be focusing on in 2023. And as the other thing I mentioned, there is a whole new section called the financial crime sections, which consists of 3 topics: cybersecurity and technological governance, anti-money laundering, fraud and sanctions, and manipulative trading. So that's an entirely new section. And actually, Bill St. Louis, who's the head of the financial crimes group at FINRA, said we wanted to highlight these sections, not only because of what we're hearing and seeing from firms, but we also wanted to just underscore our increased focus on protecting investors and safeguarding market integrity against these ongoing threats. And I got that quote from the podcast I referenced, which again, I do recommend watching. And with that, I see it is 3 o'clock. Actually, it's 3:01. So the final code for today's presentation is bills. It's bills. So first one is Giants, second one is bills. We
Those
hope everybody
could've
enjoyed this
played.
presentation today, and it was an informative as well as interesting. And again, we have a number of questions which we will try to respond to in a general email to all the attendees. So thank you for joining us, and everyone enjoy the rest of their day.
Thank you. Bye.
Is that it?